guys, welcome to Money Control, and this is Money Matters for Samvat 2079. I'm Karunya Rao, and joining me in conversation today is Kayezad Adajania, who is the personal finance editor. Kayezad, every Diwali we talk about cleaning our homes, decluttering our workspaces, and typically that theme also flows into our portfolios, our financial plans. Talk to us about why now is a good time, going by all the kind of developments we've seen in the macros, in the markets, micros, commodities. Why is now a good time or the perfect time to take a relook at one's portfolio?
Well, Karunya, just to digress a little bit, I wouldn't say that this is the only time that you should obviously take a look at your portfolio. But having said that, I think we don't want to take a look at the portfolios or our our mutual funds, our stock holdings, etc. on a daily basis. We don't want to track Sensex on a daily basis. We don't want to track our portfolios on a daily basis. So I think twice in a year, or at the most once in a year, but I would say twice in a year is a good occasion for you to sort of take a look at the portfolio. And now that Diwali is obviously a good time because it's the season of fresh beginnings, new beginnings. We have already seen much of the year gone by, and as you rightly said, so many things have happened. The Russia-Ukraine crisis, we've seen the COVID crisis gone by, and we are almost towards the end of 2022. It's a good time for us to, I think, now take stock.
And the first half of this fiscal.
And the first half of the fiscal year, yeah. So I think it's a good time for us to, take a look at the portfolio to see basically what's working, what's not working, and not be too I would say disturbed by the market noises and all of that, but to stay course on our financial goals. But yes, we have to be objective. Every once in 6 months, we have to see what's working and what's not working.
Typically, what kind of, I'm sure you are, often bombarded with a lot of questions because you track all the different aspects of personal finance, manage an entire team of, different people tracking different developments.
I try my best.
And I'm sure you're doing great, given by the response we get for our Money Control page. But what kind of questions do you typically come across when it comes to personal finance or, everybody, obviously, the end goal is to create a good corpus of wealth, not only just for themselves, but for their family, loved ones as well. It's a very personal thing. Everybody has different targets and different preferences. But some commonly asked questions, what are they? One
big question and the only question, which is the best mutual fund?
Oh, okay. Yeah. And what do you tell them?
There is no best mutual fund, actually. It's a misconception. This is something that, we've been asked several times, and I'm sure many people will continue to ask us.
You won't believe me, but people ask me also, and I tell them I don't even track it. So
no, it's not the question of tracking it, Karunya. It's the thing is that there is no one, two, or three good or the best mutual funds. Okay.
It's like asking what the best stock is to
exactly
buy.
So whatever you have to see out of the best clothes or best clothing material, I mean whatever fits you the best, or whatever works for you the best, whatever works for your financial goals the best, is what works for you. And what works for you may not be the same at what works for me, because our risk profiles are different, age would be different, our financial goals will be different, our compulsions would be different. One person would have a lot of liabilities, one person would have comparatively lesser liabilities, one person would have a lot of a large family or too many dependents to support, so you have as many goals to aspire for. The other person may not have a very large family. His or her financial goals would be a little different. So this is one thing that we must tell our viewers and our listeners and our readers at Money Control, that there is no best mutual fund or a best stock out there. There is a right fund. You have to basically, what you do is take a look at yourself. Ask yourself, why are you saving? Just because you have a monthly income and you have a discipline to, let's say, keep aside 20% or 30% of your monthly savings is not enough. Of course, that's a good start. But you also have to ask yourself as to why you are investing your money, what are your goals? And are you willing to take so much of risk, or are you not willing to take risk? Depending on these two questions, you then find a mutual fund which is right for you. So in fact, if you go to moneycontrol.com, we have a fantastic tool for our readers. It's called MC30, which is called Money Control 30. Now, what we've done is that, there are 1,000, 2,000 mutual fund schemes out there in the market. Okay. picking up the best, so-called the best mutual fund from that 2,000, 3,000 list is impossible. And it's not even advisable. There's no one right answer. What we do is that we curate a basket of about 30 investment-worthy mutual fund schemes across different categories. And then we give it to our readers saying that and we give an explanation as to why each of them is there in our portfolio. Now, what you have to do as a reader or as a listener is that you have to then go through the list, understand what these funds do for you. Is there which one would fit your goals? With this fund, would fund number 1 or fund number 2 or fund number 3, and then select a basket of just, I would say, 6 or 7 mutual fund schemes for you, and that's good enough.
So not best, but top 30.
Yeah.
And you've obviously put a lot of screening processes in place for that.
We've taken, we've looked at, obviously we've looked at past returns, but that's not the only thing. We've also looked at, we've dived into the portfolios, we've looked at how much risks these schemes take on a risk-adjusted returns, how these schemes have done. Portfolio risks we have taken, we've accounted for diversification risks, and also throughout the year, we monitor, we kind of revisit the portfolio once in a year.
Do you also tweak the list?
Sorry?
Do you also tweak the list?
Yes, we tweak the list once in a year. We don't, our aim is to not basically change the list completely. Because if we expect our readers to invest in the long run, then we also have to follow the same. But there are some funds that may sort of, go off course. There's a fund manager change in it, or, maybe there's something drastically gone wrong with one fund. We try and assess those things. And when we see that, yes, this is some kind of could be a very long lasting impact on the fund, then we sort of remove that fund and replace it with another fund. But if the fund is, let's say, punished by the markets temporarily because the entire market scenario is not played out like how we expect it to do so, and if it is a temporary thing, we continue with the course.
Okay. So while you said that there's no best mutual fund, but what is the best category of funds according to you right now in the current market when equities have, many of them have spiraled, especially the mid-cap, small-cap space. They've seen very wild swings. We continue to see, even for benchmark indices, a lot of volatility. Commodities are extremely volatile. Bond markets are looking attractive right now. So do you have a favorite in a market like this, maybe buy today for the next 3 to 5 years?
I think a multi-cap fund and a flexi-cap fund would be a good start. Okay, if you want to start building your portfolio, because these are categories where the fund manager has freedom to shift from one sector to another. Of course, multi-cap funds, as we know, they have tighter boundaries as compared to, let's say, flexi-cap funds. But there is still room for fund managers to pick up, among the large-cap stocks, mid-cap stocks, and small-cap stocks. So I'd say you start off with a multi-cap and a flexi-cap fund. I would say as far as large-cap funds are concerned, you can have one index fund is more than enough for now. You should also invest in this index called Nifty Next 50, because that's the next batch of the typical large cap stocks as we know it, and 1 or 2 good multi-cap flexi cap funds, which you can also take a look at MC30 and pick it from there.
Given the rising interest rate regime, we get a lot of questions on our regular shows about putting money in FDs, investing in bonds. Are those asset classes looking attractive right now?
Next couple of years is going to be a little tricky for fixed income bond fund investors, I would say, Karunya. But interest rates have gone up, and the yields have also gone up. So now it is a good time for us to sort of start positioning into long-term bond funds. There are a lot of target maturity funds also which are coming about, which sort of lock your money at a given yield in the market. And given where the yields have come from and given how the yields are going now, you can safely, start taking measured exposures to slightly mid-term to long-term securities through either your target maturity funds or through your mid-term or slightly long-term bond funds. So debt funds, yields have, as I said, they have gone up. So accordingly, you can take now, you can have a slightly longer-term vision of your debt fund investments.
What about precious metals? Do they look good? I mean, we've seen wild swings there as well, but off late, they have been a little lackluster, whether it's gold or silver. Are they looking good right now?
So it all depends on how the US economy plays up, and it all depends upon how the Fed keeps on increasing the rates. Okay, now that is as far as the gold prices are concerned, but as far as the portfolio and how you use that information to sort of build, imbibe gold in your portfolio, I would say that, don't look at gold really as a means of making money. Okay, it's basically a diversification measure. You put about 5 to 10% in golds. You put it through sovereign gold bonds, or you use your gold exchange traded funds, or you use your gold mutual funds. But that's the best way to take exposure in gold. Of course, how your gold prices play up, it all depends on, much of it would depend on how much the US economy expands, or how much the Fed keeps on increasing its rates.
Now, silver ETFs is something that's a fairly recent phenomena. How is that done, and is there enough appetite for it?
Look, the popularity is yet to catch up. The fancy is yet to catch up, because recently only, this year only, this is the first year that we are seeing a lot of interest in silver ETFs, and silver ETFs being allowed by SEBI capital market regulator to be launched by mutual funds. So mutual funds have started launching silver ETFs, and we will see a lot of silver ETFs action in the market, because obviously, you can't have more than one fund in a particular category. So every fund house would want to have, sort of presence in the silver ETF category. But silver prices actually don't move the way gold prices move, okay? Because gold prices, there is a lot of negative correlation between gold prices and equity indices. But silver prices have been known to move in tandem with how the economy does. So one needs to understand that, you don't look at silver the way you look at gold. As a result of which, also there are some fund houses which have now come up with a unique combination of gold plus silver in the same fund. So either they take the asset allocation decision themselves, or they just split it 50-50 and they do it in both.
Right.
But it is not such a compulsive thing to invest in a silver ETF, but yes, it is a good diversification measure within your commodities exposure of your overall mutual fund. So when I say 5 to 10%, it includes your silver.
The overall exposure should be 5 to 10%. How you do it is up to the person. Okay.
But gold should definitely be a little bit more dominant.
Okay.
Across all investors, I would say most of the investors, 5 to 10% in gold and silver is good enough. Now, between equity and debt, how much is required, the split, that depends on your own risk profile. I think about 60 to 70% in equity, Karunya, is required for most of the investors. Especially the younger you are, the more equity tilt you need to have. Even somebody in their 40s and 50s, it's very safe to have about 60% in equities. It's wrong to say that, just because you're approaching your retirement, you don't need equity. Because you also need to remember that, beyond your 60, of course, you're not going to earn much, okay? But your longevity, you need to save yourself for a life expectancy of about 80 to 85 at least. So you need your money to last for that long. So equity is the only way to grow your wealth in the long run. So you need a fair amount of equity, definitely.
Okay, so I want to steer the conversation now towards insurance, because that
Since I brought out the age factor.
And that's also very important. And when we talk about the new Samvat, we talk about Nai Shurwaat, and we talk about starting everything afresh, gifting things to our loved ones, and of course, you should also gift things that are for the years to come, and protect your loved ones and yourself. So when it comes to picking the right insurance, I know we've done some work there as well, and on Moneycontrol, with a lot of research and methodology that you guys have put together to buy the right kind of insurance. So how exactly should one go about it?
Most of the salaried individuals would have an insurance cover given to them by their employer. Okay, so that's the starting point. But you just cannot depend on your employer's health insurance cover forever, because you never know what's going to happen tomorrow. Suppose if you leave your job and go elsewhere, you can lose your insurance cover overnight. Your own company might go through some turbulent times, and as a result of it, suppose if it goes into some kind of a cost-cutting measure and reduces the employee benefits. So it could either reduce the employee health insurance cover, or in worst case, it could remove the health insurance cover. So while that is a good thing that many salaried employees are covered by their employer health insurance cover, you need to also have your own personal health insurance. Okay, so you must buy your health insurance, and that's a vital addition to your portfolio. And the sooner you buy it, the better. The younger that you are, the better. That is what I meant to say, because at that point in time it's easier for you to buy a health insurance, because you are relatively healthy. There are hardly any pre-existing illnesses, so it's easier for insurance companies also to underwrite the risks. And once it's like a lifelong contract, so once you get in, then you can keep renewing it every year. The contract doesn't get done. But you need to have your own health insurance cover, have at least 10 lakh cover, but you can go up to as much as 40-50 lakh also, and you should over a period of time.
But let's say if you're buying insurance for an entire unit, is it better that one takes individual policies, or should you take it as a group? Are there any benefits or any differences?
You mean as a family floater? Yeah. You can take it as a family floater also.
But does it have any benefits, or is it largely more or less the same thing?
It's look, it depends on what is the composition of your family. If there is a lot of if there are a lot of senior citizens in your family, and if your parents have a lot of pre-existing illnesses, then a separate cover for them and a separate cover for you is beneficial, ideal. Because if you find that your family floater is being utilized by a few family members more, then it kind of comes to hit you when some other family members get admitted in the hospital and you need to get those hospital costs reimbursed, only to find out that you've already utilized your cover over there elsewhere. So it depends on your family composition. But family floaters are also perfectly fine. Individual health policies are also fine. I'm a little bit of a conservative person by nature, so I would recommend an individual health policy is always, better.
Ideal. Okay. I'm going to ask you one question that you have been asking a lot of fund managers and CIOs for many, many weeks now. How would you invest 10 lakh rupees if you had? How would you construct a portfolio which could, according to you, yield good returns over the long haul?
I like equities. Okay, I'm a firm believer in equities, especially Indian equities. 70% in Indian equities. 70% in equities, out of which about 50% or 55% would be Indian equities. The rest would be international equities, because you have to also, in equities now that international avenues are open for Indian investors and Indians are investing abroad, and global markets are there for picking, you should invest internationally also. So I would invest about 10 to 15% internationally also within my overall equity exposure. About 10%, 7 to 8%, I would put my money in a mix of gold and silver, with more emphasis on gold, very less emphasis on silver as of now, and the remaining in debt.
20% in debt.
Yeah.
Okay, so now we know that how you will spend those 10 lakh rupees, something that you've been
If I have 10 lakh
asking.
to invest.
I'm sure you do. Well, on that note, Kayezad, thank you so much for chatting with us and for talking to us about all of these asset classes in such great detail. I'm sure our viewers are taking back a lot from today's conversation. Pleasure to have you on board.
Pleasure. Thank you.
And guys, thank you so much for tuning in as well. We wish you all a very happy Diwali and season's greetings from all of us at Moneycontrol.